Taxes.
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 Taxation.
Taxation.
Well, hold on, Becky, hold on.
Tax refund.
So it's that time of the year again where everyone is getting ready to prepare their tax returns. So in this video, I'm gonna run through 10 ways for you to legally pay less tax to hopefully save you thousands of dollars when you do your tax return. There's been some major changes to taxes, so it's more important than ever to stay on top of those changes. I'll also be highlighting what the ATO will be targeting this year in their audits so that you can reduce your audit risk. The first way to reduce your taxes is to ensure you're claiming your work from home expenses properly. Now, this is also one of the main areas that the ATO has flagged that they'll be focusing on this year because they believe that people have been incorrectly claiming their work from home expenses and are essentially double dipping on their claims. So you'll definitely want to pay close attention to this part. So there are currently two methods on how you can claim your work from home expenses. The first way is the revised fixed rate method, which allows you to claim 67 cents for every hour that you work from home. This covers your mobile expenses, internet expenses, electricity and gas for heating, cooling and lighting, and also stationery and any computer related consumables. This means that you actually can't claim for any of these costs elsewhere in your tax return. Otherwise, you're double dipping. And the ATO may flag you for an audit. Now, what is excluded from the fixed rate method, which means that you can claim these elsewhere, is for the depreciation of work-related assets such as laptops and computers, repair of those assets, and cleaning if you have a dedicated office space. The second method is the actual cost method, which involves you claiming the actual work-related percentage of all of your expenses. So this is essentially going to include everything that was in the fixed rate method, and you'll need to calculate the actual work-related percentage of this. The challenge with this method is obviously the record keeping side of things, because you're going to need to know what the actual percentage is that you've used for work-related purposes. And the ATO is going to expect you to keep accurate records for this. And record keeping is another thing that the ATO is cracking down on this year. So for something like your phone, you're going to need to keep a 4-week diary on your work-related usage. And this essentially extends to every other item that you're looking to claim an expense on. Generally speaking, if you don't have a lot of work-related expenses to claim, then the fixed rate method is probably much easier. However, if you have incurred a lot of work-related expenses, then using the actual cost method can actually end up saving you significantly more. So ideally do both calculations and then choose which one will maximize your own tax returns. The second category is ensuring you claim all of your work-related expenses. Now, this is in relation to expenses that you haven't already claimed for your work from home expenses. Now, as long as you could substantiate that the expenses that you incurred were directly related to earning your income and you have the relevant receipts, then you can actually claim it as a tax deduction. This is pretty much where you can get a little bit creative with your tax return, and you'd actually be amazed at what you can actually legally claim. For example, if you're a female, did you know that you can claim your handbag or your work bag that you purchased as a work-related expense? So my partner uses this Longchamp bag so she can carry her work laptop, food, lunch, and all her other little bits and bobs to work, and she only ever uses it when she goes to work, meaning that she could claim the cost of that bag as a 100% work-related expense. The ATO actually has a full guide on their website for work-related expenses based on occupation and industry. If you want to know more in detail about what you specifically might be able to claim, then head on over to that site and I'll leave a link in the description. The third way to reduce your taxes is claiming any car-related expenses. So if you're someone who uses your personal car for work-related travel, then you can claim expenses such as fuel, repairs, and maintenance. Note that this doesn't include getting to and from your workplace. However, if you're required to travel to a client site, then that can be included. There's two methods that you can use to claim car-related expenses. You can either use the cents per kilometer method, where you can claim 85 cents per kilometer traveled, and you can claim a maximum of 5,000 work-related kilometers per car. And the 87 cents covers everything from the depreciation in value, registration, insurance, repairs, and fuel costs. As always, make sure to keep an accurate log, either in a diary or using the My Deductions app from the ATO. The second method is the logbook method, where you'll need to keep a log of all of your work-related trips for a continuous period of at least 4 weeks. You also need to keep receipts of all of your car-related expenses, so once again, a much more tedious way of doing things. The cents per kilometer method doesn't actually need you to keep any receipts, but once again, just do both methods and see which one's going to maximize your tax returns. The fourth way to maximize your tax return is by salary sacrificing into your superannuation. Superannuation is a tax favorable environment, meaning any contributions that you make to it will only ever be taxed at 15% as opposed to your own marginal tax rate. Whenever you're salary sacrificing, you're essentially reducing your taxable income. This means that we can use this to our advantage to save hundreds of dollars, if not thousands of dollars come tax time. Let's walk through a simple example to demonstrate. So for example, if you had a salary of $100,000 and you decided to sacrifice $5,000, in the eyes of the ATO, your taxable income has now reduced to just $95,000. So on the $5,000 that you sacrificed, you would only have to pay $750 in taxes, as opposed to your marginal tax rate of 32.5%, where you would have had to pay $1,625, resulting in an immediate tax saving of $875. Now, a key thing to note about salary sacrificing is that the earliest that you can actually access those funds is when you're 60. So only consider doing this if you don't plan on using that money for the long term. The fifth method is to optimize your capital gains tax strategy. If you've ever bought and sold shares at a profit, then there are tax strategies that you can leverage to minimize the amount of taxes that you need to pay to the ATO. When you sell an asset like a stock or a house at a profit, you can choose to pay the lower long-term capital gains tax, which entitles you to pay only tax on half the profit you made, assuming you held the asset for longer than 12 months, as opposed to if you held the asset for less than 12 months, where you need to pay tax on all of your profit. Secondly, you can actually use any capital losses that you may have occurred to offset your capital gains, which reduces your overall tax liability. So for example, if I made $10,000 on Nvidia stocks, but lost $8,000 on Dogecoin, my total tax liability would only be $2,000. Also note that you can carry forward your capital losses that you've incurred into future years to offset future gains, and there's no time limit on how long you can carry forward those losses for. The last method is to modify your sale allocation method. Whenever you're selling shares, there's several sale allocation methods that you can use to help you optimize your capital gains tax position. The default one that most people use is first in, first out, meaning that you sell the shares that you held the longest first. But there's two other methods that you can leverage. They are last in, first out, which assumes that you sell your most recently purchased shares first. There's also highest in, first out, which assumes that you sell the shares with the highest purchase price first. So by playing around with these three different sale allocation methods, we can literally optimize our capital gains tax so that we pay the least amount possible. The important part is that you've actually kept an accurate record of your shares, and you're able to identify specifically which shares at what price you're selling. If you're doing this all manually, it can be extremely complicated. However, if you use a share tracking tool like SHARESIGHT, then this makes your life so much easier. With SHARESIGHT, you can easily track all of your shares that you've ever bought and sold and at what price. You can also easily run capital gains tax reports and play around with the sale allocation method in order to optimize your capital gains tax position. You can then just hand this report to your tax accountant, and that's all they'll need to do your tax return. If you had have done this manually, this would have been a huge pain to do for yourself or your accountant. I have been using SHARESIGHT to track my shares for years now, and just being able to run these tax reports has saved me hundreds of hours each year and helped me optimize the taxes that I've had to pay. If you're interested in signing up to use the same feature to help you with your taxes, then sign up using the link in the description and you can get 4 months off an annual plan. The sixth method is ensuring you're appropriately covered with private health insurance to avoid the Medicare levy surcharge. The surcharge is essentially an additional tax imposed on higher income earners who don't have an appropriate level of private health insurance. Now, everybody already pays a 2% Medicare levy, but if you earn more than $93,000 yourself or more than $186,000 as a family household, then you'll be liable to pay a Medicare levy surcharge of between 1% to 1.5% depending on your income. So if you have an appropriate level of private health insurance, you can essentially avoid paying that additional surcharge. However, I would still highly advise doing the calculations yourself as to whether or not it makes sense for you to take out private health cover. Because with rising private health insurance costs, the cheapest plan that I could find for basic hospital cover still costed around $1,000 per year. Meaning if you're someone earning less than $100,000 per year, it actually makes more sense for you to not take out that plan. The seventh method is in regards to donations. A lot of people forget that you can actually claim a tax deduction for most of the donations that you can give. However, it is important to check that the organization that you've donated to is endorsed as a deductible gift recipient. You can do this by going to a website called ABN Lookout and then type in the organization's name or their ABN, and then just look for their deductible gift recipient status. If they are endorsed, then you are allowed to claim your donation as a tax deduction. The eighth method is claiming any expenses in relation to managing your tax affairs. You can claim deductions for the costs that you've incurred in preparing your tax return. So this could be as simple as your tax agent fees, or maybe you pay for software that helps you manage your tax affairs like SHARESIGHT. The cost of that software is also tax deductible, and this is an area that people quite often forget to claim. The next tip is claiming your clothing and laundry expenses. If you're required to buy or wear specific clothing for your occupation, you may be able to claim those expenses. Now, there are two main categories for clothing. There's occupation specific, which is any clothing that would identify you in public as being that specific occupation. For example, a nurse will be able to claim a deduction for buying their scrubs. A flight attendant would be able to claim their uniform. Protective clothing is another big one, and this covers anything that's high vis or just protective in nature, such as steel-capped tools or UV specific clothing. You're also able to claim any money that you spend on washing or repairing those clothing. The 10th and last method is the instant asset write-off, eligible for small businesses. Now, if you weren't aware, this measure was announced previously as a part of last year's federal budget. Essentially, small businesses with an aggregated turnover of less than $10 million will be able to immediately deduct the full cost of any work-related asset that costs less than $20,000. The $20,000 threshold will apply on a per asset basis, so small businesses can instantly write off multiple assets. Now, the great thing about this is that in this year's federal budget, they've announced that they're extending this measure until 30th of June next year in 2025. So you no longer have to rush to buy all of your assets, but if you do want to write it off as a part of this year's tax return, then make sure you buy it and install it before 30th of June 2024 this year. So those are the 10 ways that you can legally pay less tax in Australia. Now, just note that I'm not a tax accountant, and these are just my own findings as I've been doing my own research to ensure that I'm maximizing my own deductions. So please consult a tax accountant if you're not sure with anything. Now, if you found value in this video, make sure to hit that like button down below, subscribe to the channel, and if you've stayed this far, drop me a comment with the word tax in it so I know you've watched the whole way. Now, if you're interested in learning about how the ultra rich in Australia essentially pay $0 in taxes, then check out this video right here.